Welcome. Today, we are diving into something truly powerful for traders to understand market behavior, and that is the time price opportunity chart. By the end of our time together, you will have a clear understanding of how to read these charts. You will know how to identify key price levels and how to use this knowledge to make better trading decisions. So stick with me and let us get started right away. Have you ever wondered where the market truly finds value, where price lingers, and what that tells us about the market's behavior? Let us introduce you to the time price opportunity chart. A time price opportunity chart is a unique way to visualize market behavior, showing how much time the market spent at specific price levels during a trading session. Unlike traditional price charts, which focus mainly on price movements, the time price opportunity chart emphasizes the time spent at particular price levels. The key to understanding these charts lies in recognizing that they reveal the areas where the market found value by lingering at certain price levels. Why is this important? If the price remains at a specific level for an extended period, it indicates that both buyers and sellers agree on that value, making it significant. This can help you understand where support and resistance are likely to form, giving you valuable insight into potential market behavior. There are a variety of chart patterns that can appear on time price opportunity charts, each of which tells you something different about the market. Let us expand on these patterns in more detail. The ** balanced profile * pattern resembles a bell curve where most of the market activity happens around the middle price range, and there is less activity at the extremes. This pattern indicates that buyers and sellers are in agreement, suggesting a period of consolidation or a market that is in balance. Traders might consider trading within the boundaries of this profile, buying at the lower extremes and selling at the higher extremes, as the price tends to rotate within the range during balanced conditions. Another pattern is the ** imbalanced profile *, where there is significant activity at one side of the profile, creating an elongated or skewed shape. This type of pattern indicates a trending market where one side of the market is overpowering the other. In this scenario, buyers or sellers are driving the price in a particular direction with strength. The lack of time spent at intermediate levels shows that there is urgency in the market, suggesting that traders are quickly pushing the price, and support or resistance is less likely to form at these intermediate levels. The ** P-shaped profile ** and ** B-shaped profile * are also commonly seen in time price opportunity charts. A ** P-shaped profile * forms when the market initially consolidates, followed by a breakout to higher prices, resulting in an elongated profile with a bulge towards the top. This pattern is often seen in short covering rallies, where traders who are short begin to exit their positions, driving prices higher quickly. Conversely, a ** B-shaped profile * indicates the opposite, where there is significant activity at higher levels before a sell-off occurs, resulting in a bulge towards the bottom of the profile. This can indicate long liquidation, where buyers who were previously confident are now exiting their positions rapidly, causing a drop in price. Next, we have ** single prints *, which represent areas on the chart where the market moved quickly through a price level with very little trading. These single print zones can serve as key reference points because they represent levels that have not been fully tested by the market. If the price returns to a single print area, it often becomes a point of interest, acting as either support or resistance depending on the context. Single prints typically occur during fast moves and can signify strong momentum, often leaving gaps that attract future price action. Spike profiles are another type of pattern you might see on a time price opportunity chart. These occur when there is a sudden surge in price, leading to a sharp spike on the profile. Spike profiles are often the result of sudden news or unexpected market events that push the price rapidly in one direction. These spikes can be followed by either continuation or reversal, depending on how the market participants react after the initial surge. Monitoring how the price behaves after the spike can help traders gauge whether the move was a genuine change in market sentiment or an overreaction that is likely to be corrected. Double distribution profiles occur when there are two distinct areas of trading activity separated by a region with little to no trading. This type of profile suggests that the market experienced a significant shift, such as a breakout followed by a consolidation at a new level. The two distributions can act as support and resistance zones, with the area between them often representing a low volume area that the price can move through quickly if revisited. Double distributions are particularly helpful in identifying key zones where the market has adjusted to new information and where future tests may lead to decisive price action. Double distribution profiles often indicate that there is a transitional phase in the market. For example, during a major news release or economic report, the market might break out of a previously established range, trade heavily in a new area, and then establish a new balance. The gap between the two distributions is often called a low volume node and it is a critical level to watch because it tends to act as a fast move zone. When the price revisits this area, it can move rapidly due to the lack of previous trading activity, providing potential opportunities for quick trades. Traders often use this information to plan for potential breakout or fade trades as price moves between the distributions. In addition, double distribution profiles are especially important when looking at multi-day charts. They can highlight significant structural shifts in the market, where the value has changed due to changing conditions such as new economic policies, earnings reports, or geopolitical events. By recognizing these profiles, traders can adapt their strategies to align with the new market environment, using the two distinct distributions as key levels for setting entries, exits, and managing risk. These various chart patterns help traders better understand the market's condition, whether it is balanced, trending, or responding to significant events. Recognizing these profiles and knowing how to interpret them allows traders to make more informed decisions, adjust strategies accordingly, and identify potential trading opportunities. Let us take a look at how these charts are actually structured. The time price opportunity chart is made up of what we call time price opportunity blocks. Each block or letter represents a set amount of time, and this is usually 30 minutes. Picture the price levels from top to bottom on the chart, and then imagine placing a letter at each level where the market traded for that 30-minute chunk of time. The longer the price stays at a level, the more letters pile up in that spot, and you end up with a sort of shape that shows you where the market lingered the most. Instead of showing where the market has moved quickly, these charts show you where the market has paused. It is a different way of seeing the market that helps you understand where traders found value. Let us talk about some of the key parts of this chart. First, we have what is called the point of control. This is the price level where the market spent the most time during the session. You will see the highest concentration of letters or blocks right there. This price level often becomes important because the market sees it as fair value. So keep an eye on that point because it often acts like a magnet for future price action. Another key part of the chart is the value area. Now, what do we mean by the value area? The value area is the price range where 70% of all trading activity occurred during a session. This means that the majority of traders considered the price within this range to be reasonable. The value area is crucial because it often acts as a zone of support or resistance. If the price is moving within the value area, there is a high probability that it will continue to oscillate between the value area high and the value area low, providing multiple opportunities for trading within these boundaries. The ** value area high VH** is the upper boundary of this range, while the ** value area low VL** represents the lower boundary. Traders often use these levels as signals for potential buy or sell opportunities. For example, when the price approaches the value area low, it may be a good opportunity to buy, anticipating that the price will move back up through the value area. Conversely, when the price nears the value area high, it might present an opportunity to sell, expecting the price to rotate back down. One important concept to remember is that the value area highlights where market participants found value, and these levels can change over time based on market conditions. A breakout above the value area high or below the value area low may indicate a potential shift in value perception, often leading to trending price movement. In such cases, it is essential to watch for confirmation, such as increased volume or momentum indicators, before committing to a breakout trade. Additionally, during periods of market consolidation, the price is more likely to stay within the value area, moving between the value area high and low. Traders can take advantage of this behavior by employing range-bound trading strategies, buying near the value area low and selling near the value area high. On the other hand, during trending markets, the price may break out of the value area and form new value levels, signaling a potential opportunity for traders to participate in the trend. Overall, understanding how to identify and utilize the value area, along with the value area high and low, can provide a significant advantage in spotting high-probability trade setups and making well-informed decisions based on where the majority of market participants have found value. We also have something called the initial balance. This is just a fancy way to describe the price range established during the first hour of trading. The reason why this first hour is so important is that it often sets the tone for the rest of the day. If the price breaks out of that initial range, it can sometimes signal that a bigger move is about to happen. Day traders watch this closely because it can be the start of a strong trend for the session. Now let us talk about how you can use these charts to spot trading opportunities. One great approach is to look at the value area. When the price is moving inside the value area, traders often expect it to move back and forth. Imagine buying near the bottom of the value area and then selling when it reaches the top. This is what we call a rotation trade. It is like expecting the price to bounce between support and resistance. Another useful strategy is to watch for what is called reversion to value. This happens when the price moves outside of the value area, but eventually comes back inside. If that happens, there is a pretty good chance it will rotate back all the way through the value area. This gives you an opportunity to catch that movement back toward the middle. And of course, we have to talk about breakout trades. When the price breaks out above or below the value area, it could mean that the market is ready to start a strong trend in that direction. This is especially true if it breaks above or below the initial balance set during the first hour. The key here is to wait for some confirmation. We do not want to jump in without making sure there is enough momentum behind the move. Watching volume can help confirm if the breakout is likely to stick. One really interesting part of time price opportunity charts is that they come in different profiles, and those profiles can tell you a lot about what is going on in the market. For example, a balanced profile looks a lot like a bell curve. This happens when buyers and sellers are in agreement about the value, and there is no major push in either direction. Usually that means we are seeing a period of consolidation or sideways movement. But sometimes we see an imbalanced profile where the price moves more vertically up or down. This happens when one side is clearly in control and the market is trending. The price moves quickly and does not spend much time at certain levels, which can indicate strength behind the move. It is something to watch for when we think the market might be picking a direction and running with it. And then we have single prints. Single prints appear when the price moves quickly through a level without much trading happening there. These levels can act like support or resistance if the price comes back to them. They represent areas where the market has not really filled in yet, and they often become important again when the price revisits them. So how do we make the most of these time price opportunity charts? One good approach is to use them along with other tools. The volume profile is a great partner for these charts because it shows us how much volume was traded at each price level. This adds more context to the picture. For example, if we see that a certain price level had a lot of volume and a lot of time spent there, it is probably an even stronger support or resistance level. Moving averages are another useful tool to add to these charts. They can help confirm trends, reversals, or even provide dynamic support and resistance levels. A moving average smooths out price action by averaging the closing prices over a specified period, which makes it easier to see the overall trend direction. For example, if the price breaks out of the value area and simultaneously crosses above a key moving average, such as the 50 or 200 period moving average, that could be a sign that a strong move is beginning. Moving averages are particularly helpful in differentiating between a short-term pullback and the beginning of a trend reversal. Additionally, traders often look at the interaction between two moving averages, such as the crossover of a shorter moving average over a longer moving average, to identify potential buy or sell signals. These crossovers, commonly referred to as golden cross when moving upwards or death cross when moving downwards, can provide strong indications of shifting market sentiment. Combining these moving average signals with other elements of the time price opportunity chart provides a more comprehensive understanding of market momentum and trend direction. Momentum indicators like the relative strength index can also be helpful. If we see a breakout on the time price opportunity chart and then we see the momentum indicator showing strength, it gives us a better idea that the breakout is likely to continue. Let us go over some key levels to watch on these charts. First and most importantly, always keep an eye on the point of control. It is the level where the market spent the most time, and it can act as a magnet for the price. When the market moves toward the point of control, it often gets drawn all the way to it, which means it is a good level to watch for possible reversals or breakouts. The value area high and low are also important. These are the edges of that zone where most of the trading happened. If the price is at the value area low, that could be a good spot to consider buying because it might move back up through the value area. And if it is near the value area, high, it might be a good time to look for selling opportunities. And of course, we cannot forget about the initial balance from the first hour of trading. When the price breaks out of that initial range, it can sometimes lead to a strong trend day. So make sure to pay attention to those early moves. Now let us talk about managing risk. This is a critical part of any trading strategy, especially with time price opportunity charts. Always use a stop loss to protect yourself. A good idea is to place your stop losses just outside the key levels like the value area or the point of control. This way, if the market does not do what you expected, you will limit your losses. Your strategy should also adjust based on the market conditions. If the market is balanced and moving sideways, keep those stops tight because the price is likely to stay within a range. But if the market is trending, allow more room for fluctuations. The market might move back and forth a bit before continuing in the trend direction. Let us also touch on some common mistakes traders make when using these charts. One mistake is overtrading small movements. Just because the price moves outside of the value area or point of control does not mean it is significant. It is important to wait for real confirmation before making a trade. Another mistake is ignoring the bigger picture. Always be aware of what else is happening in the market. Big news or economic releases can make time price opportunity levels less reliable, and the price may ignore those levels altogether. And finally, make sure you have confirmation before acting on a breakout. It is tempting to jump in as soon as the price moves out of the value area, but without volume or other signals, the move could be a fake out. Waiting for a little more proof can save you from false signals. If you are new to using these charts, the best way to learn is to start with a practice account. Use it to identify key levels like the point of control and the value area and practice trading around these areas without risking real money. Keeping a journal of your trades is also a fantastic way to learn. Write down why you entered a trade, what happened, and what you learned from it. Over time, this will help you see patterns and improve your decision making. Also, do not be afraid to try different time frames. You might find that daily, weekly, or even shorter intraday charts work best for your style. The key is to keep testing and adjusting until you find what suits you. So let us recap what we have covered today. Time price opportunity charts give us a unique view of the market by showing where the market spent the most time. We talked about important levels like the point of control, the value area, and the initial balance. We discussed how you can use these levels to spot trading opportunities and how combining these charts with other tools like volume profiles and moving averages can give you a more complete view. Remember, practice makes perfect. Start using these charts, focus on the key levels we talked about, and always manage your risk carefully. In time, you will see the benefits these insights bring to your trading. Thank you for joining me today, and I encourage you to keep exploring and practicing with these tools. If you have questions or want to discuss more, let us keep the conversation going. Your journey with trading is all about learning and growing, so stay curious and keep improving.